Hey everyone, welcome back to the channel. Today we're going to be going over 5 dividend REITs that will continue to make your portfolio even better for 2023 and as we look out into 2024. Now, these 5 REITs will target 3 different areas: high dividend yield, diversification, and potential for capital appreciation. So without further ado, let's get into it. However, before I baited you a little bit, before then, feel free to like, subscribe, and leave a comment down in the comment section. I will have this entire video timestamped, so if you're interested in a specific REIT after you've watched all the way through, don't hesitate to go ahead and skip ahead. All right, so 5 REITs for 2023 that I felt were the most important that I'm going to be adding to my portfolio for 2023 to start 2024 off with a bang. All right, speaking of a bang, let's talk about Realty Income. First off, Realty Income, I've talked about this before on the channel, and I've talked about this on my Twitter page. I am an investor of Realty Income. I was actually out in California last week. I drove by Realty Income, couldn't help but stop in just for a minute and see what it's like. The 6.19% yield on dividend or on Realty Income makes it very, very appetizing. They have a consistent track record of dividend increases, and the property sector they're in is office sector. Now, I know what you're thinking. So office with commercial real estate over the last several years when it comes to higher interest rates, COVID borrowing, and the flee to work from home can make it potentially unappealing. I want to just stop the worries there. The Realty Income is a triple net lease REIT, which means that its tenants are responsible for all the property maintenance and operating expenses. So that makes it somewhat of a lower risk REIT. One of the other things that I like, as I move over here into the actual returns of Realty Income, so all the way back when they IPO'd back in '94, they've had a consistent up and to the right track record of not only producing results, increasing their dividends, but also taking care of their shareholders. And their CEO, Sumit Roy, is someone that I have immense respect for. Now, if I head over to their page, I can actually see some of their returns right on the front page. This 14.2% compound annual total return since '94 is accurate, and the 4.3 compounded annual dividend rate since the '94 listing is accurate as well. This one's the big one though. If you take away nothing from Realty Income, I want you to take away this: 639 consecutive months of dividends declared. It's predictable. It's going to continue to give you forward-looking revenue as you look out into 24, and it's very, very predictable. And then 104 consecutive quarters of increases. So again, if I go back and look at the stock, the range is traded in this year is 48 to 68. So I think if Realty goes below 49 or 48.50, I'll pick up some more shares. Between the dividend, the capital appreciation, and the dividend, the growth that they're seeing returning more back to their investors, I think it's for sure a winner. Now, number 2, Stag Industrial. Real quick, before I get into Stag Industrial, comment down below if you know what Stag Industrial is and if you're invested in it. This was actually one that during my research for this video came up. I was very, very surprised at how unaware most people are of Stag Industrial. And it's for one reason, I think the yield is good, but I just don't think it's a high flyer like Realty or some of the other ones I have. Doesn't mean it's not important, but I really want you guys to focus in on Stag here. All right, Stag Industrial out of Boston, over the last, since 2011, IPO'd at $12.75. So you've got about 165% return over the lifetime. Now the yield on this is 4.56, so a little bit lower than Realty, but they play in a different area. So they operate in the industrial property sector, not the commercial real estate. They do have a proven track record of increasing dividends. If I move back over here, you'll actually see they do pay out dividends every quarter, and then during COVID back in 2021 they peaked at 47. I still think this is a great play, and if I look down here at some of their revenue, so year over year, actually let's go annual. Annually, they have an increase, 16.93% from last year. Operating expenses, unfortunately, were up. Net income was down. Their profit margin is down. Their EBITDA, though, which is what I track a lot of companies off, EBITDA, earnings before interest, tax, deductions, and assets. That's what I typically track a lot of my companies at when I'm doing book value and analysis of whether I want to invest. Their balance sheet looks very clean. Cash and short-term investments actually went up. Their assets went up, and their liabilities did go up. But overall, I still think it's a great buy and hold, a great dividend with a lot of attractive qualities about it. Okay, number 3, Welltower. Now, again, much like Stag Industrial, how many of you knew about Welltower? If you did, comment down below, hit the subscribe button, let me know if you did. Again, this was another one that I was a little surprised with. So they operate in the healthcare property sector, which, as we know, people are getting older, people are continuing to live longer, they're going to continue to need aftercare and hospice care, and this is what Welltower, the primary function of them is to provide investors with exposure to healthcare real estate. What does that mean? That could be retirement facilities, could be hospice facilities, it could be senior living facilities. These are all areas that I see a tremendous growth for and a tremendous demand for as we head into the back half of this decade and into 2030. Now, if I move over into Welltower's analysis here of their stock, if I go back to 1983, sorry, they IPO'd at $10. So you've made 686% if you had invested in this at the IPO. Yields 2.89%. I think I forgot to mention that, but still very, very, very attractive. They're headquartered out of Toledo. If I head over to their website, you could see they talk about healthcare infrastructure to provide their tenants with lower costs and better quality of life. I really like this because not only are you able to make money off this, you're able to have a good dividend, you're able to have increases in capital, but you're also doing something, you're providing a good and a service, for the community. We're going to need care for the elderly like this in perpetuity. There's no situation where I don't think people are going to be continuing to live longer. Let's move over into number 4. So number 4 is Essex Property Trust. A very strong yield at 4.36%. They do have a good track record, just like the others in this list. They're a real estate investment trust. They work in the apartment complex. So if you've ever rented an apartment, which I think most people have at some point in their life, could have been in college, could have been after, maybe you're in an apartment right now because prices of homes where you live are just too damn high. Maybe that's it. But Essex Property, I'm going to move over here into the chart. Essex Property up 1,000% since IPO. And I think that's for a couple reasons. One, the demand for apartments and that turnkey experience will continue to flourish as, again, we go back to what Welltower was doing. Either people are going to be in their senior years or their elderly years living in apartments, full turnkey facilities where they don't have to worry about anything inside or outside. They pick up the phone, everything's taken care of. Plus, one great thing about apartments is you're able to raise the rent accordingly to track inflation. So if inflation goes up 10% a year, you're able to raise the rent that much and people will pay it, and you don't have to worry specifically a lot about a lot of attrition or rollovers in these properties. Now, over here, they break it down where they're actually invested primarily, mostly the Pacific Northwest of the United States. So San Francisco, Washington, they do have some stuff in Southern California. If I click on one of these, you can see a lot of their complexes that they own are in the urban and residential areas. So you don't see a lot of, I guess you do see some suburbs out here of LA, but you've got San Francisco Bay, you've got South Bay, you've got East Bay, and then when you go up to Washington, you've got Seattle, which is great. I like these locations because, one, they're tech heavy, they're tech dominant, especially in Washington with Seattle. Number 2, I like them is because they're in highly populated and concentrated metros where they are, again, able to raise rates and raise rent every single month or every single year as they need to accommodate inflation or growing demand. So Essex Property Trust is definitely up there. Okay, we're about to show number 5, but before I do, again, if you find value in this, please leave a comment, leave a like, think about hitting subscribe. Really helps me and my team to provide these videos for you, provide this great content and this research. As we all know, research isn't free, it does take time. I thoroughly enjoy it and I thoroughly appreciate everyone who joins in and watches me every single week. I can't thank you enough for providing me the ability to do this. Okay, number 5, last one is WP Carey. Now, I think some people may have thought of WP Carey. I had them on my list. but I wasn't sure where they would fall. And by the way, this list is in no particular order. So while WP Carey is the last one on the list, it is by no means the last one. This would be a bucket of REITs that I would invest in. I wouldn't stack rank these based on the way I've went through them today. So don't think WP Carey's at the bottom of the list. If anything, it's probably more towards the top. So you see a solid dividend yield of 8%. Again, they have a history of consistently increasing their dividends, and they specialize in industrial warehouse sectors, so distribution centers and storage facilities. What is that? What's that synonymous to? Well, think about an Amazon or a FedEx or a UPS last mile delivery hub. As things are becoming more and more e-commerce, things are shipped to people, and people now expect things within 24 hours. It used to be 48, now it's 24, and some people expect things same day. These last mile facilities will become more and more and more important as we begin to commercialize and digitize everything online, and we push more out to mobile, we push more out to e-commerce. Having real estate that's close to your consumers, whether it's a last mile hub, a distribution center, whatever that is, that's extremely important. Now let's look at WP Carey. Let's look over there at their stock. So over the last, they've been out since 98, 147% increase. So you'd have more than 1.5 your money. Now it looks like they did peak a little bit during COVID. They went back up, and over the last year, they are down 31% this year, even with a high yield. I still think at these prices it's a buy, because if I go back even 5 years, you're seeing them all the way up to 93. I think at these prices, if you're a long-term holder, it's something you should seriously invest in. Now, if I head over to their website, I can look at some of their acquisitions, but let's look at their portfolio first and see what kind of assets they have, what kind of assets you'll be investing in. So they have 1,475 properties. Their base rent's $1.5 billion. Occupancy rate's very good at 99%. 398 tenants, and I'm guessing here we go. If we look at this, most of it's in the United States, some's in Europe. So if you're looking for that global REIT, you've got it right here with WP Carey. Property diversification type, very well diversified, industrial, warehouse, some retail, and then a little bit of office and self-storage, but predominantly industrial and warehouse and retail, which I love. And then we've also got a big diversity when it comes to the actual tenant diversification. So we're not just saying it's Amazon or Walmart or FedEx. We're actually saying we got healthcare, cargo, business services, construction, hotel, leisure, insurance. They've kind of got it all. Top 10 tenants down here in case you're interested: U-Haul, Metro Cash, Hellweg, OBI. U-Haul's a big one though, so everyone sees U-Haul trucks on the road every day, and down here you can actually see where they're located. All right, so in conclusion, REITs can be a great way to invest. I don't want anyone to think that this is the only way to go, but they're an excellent investment option. Realty Income, WP Carey, I've went through all these. They offer attractive yields. They offer a history of dividend increases. You have a diverse property set of properties across a dynamic group of portfolios. You've got location diversity, you've got tenant diversity, and you've got yield diversity as well. So some are higher, some are lower. What I want you to understand and take away from this is there's no one right or wrong way to do it. You could buy all 5 of these, or you could buy one. What I want you to take away from this is I want you to make sure you're doing your research. I want you to make sure you understand the pros and cons of investing in REITs, because as we saw with WP Carey in the last REIT I showed you there, they're down 27% year to date. So, know what you're getting into. Yes, you still get the yield, and in some cases it may be better just to buy T-bills rather than get into REITs at this time. It's up to you. I do have a video that I just finished on Fundrise, why I exited to deploy capital in REITs exactly like this. So I'll post that down below. I'll also post this presentation down there along with the links to all the REITs that I described today. So comment down below. Let me know what you think. Are you investing in any of these? If so, which ones? And as always, don't forget to design your financial freedom. Take care. Bye-bye.